Hello, Dhwani. Yes, how are you? Very first one today. How are you guys? How's everyone? Hello, Sakib. No, I'm not well dressed yet. Hi, Hamza. How are you doing? How's your preparation? Going well? Nice, Ayan. Yes, last day. But this would be last day for the webinars. We'll remain in contact. I'm perfectly well, Akis. Akis, you're not very active on the WhatsApp group. Are you on the first group or the second one, the newly one made one? Oh, good, good. Fair enough. Not an issue. So, last day, and you people have highlighted some areas that I'll try to cover apart from my planning. But let's move towards the plan section first. And few of you students were asking me, requesting me, and requiring me to cover some cash flow areas. So, at very short notice, I've tried to manage a question, and there might be some mistakes in it, but I hope everything will go fine. Question on your screen. It says Frey Limited is a drinks manufacturing company. Fair. So the main business operation is drinks manufacturing. Attendance seems a bit short today. Okay. Preparing its financial statements for the year ending 30th June 2021. Quite fast. Preparing the statements for the time that hasn't yet arrived. But having some troubles with treatment of transactions. Possibly, Zayan, you can drop a text kindly there. I believe I'm missing those foreign participants. This would be the first time that Pakistanis are punctual. We are normally never at time. Hi, Sam. You there? Nice to see you. Okay. Let's move forward and send them a reminding text that webinar has started. But having some troubles with the treatment. Good evening, Jaya. You there? The following exhibits provide information relevant to the difficulties in preparation of statements. I believe this might be something new for you, possibly. Are you guys okay with IFRS 2? No revision needed? IFRS 2? Yes, Dhwani, okay with IFRS 2? Revision needed, okay. Okay, what does IFRS 2 actually states? IFRS 2 is related to the share-based payments. This one, Purus, the one that's on my screen, this question number 3, I believe you can find this in this handout section. It is over there. Question number 3. Yes, it is there. Not an issue, Ola. We are used to it, joining late. But fair, welcome. Good evening, yes. IFRS 2, yes. IFRS 2 deals with share-based payments. And there are 2 types of share-based payments. One is equity settled share-based payments and other cash settled share-based payments. What's difference? Equity settled share-based payments will be settled by issuing companies on equity instruments. So if the payment is supposed to be made in any other company's shares, that will not be treated as per IFRS 2. Anyone else facing the voice issue except Purus? So equity settled share-based payments will be settled by issuing okay, Sam. Okay, Hamza. Good. Zayan, fine. By issuing entities on equity instruments, make sure if company buys any goods or enjoys any services and pays in any other company's equity instruments, that is not share-based payment. Will be settled by issuing entities on equity instruments against the goods or services, except share exchange in case of business combination. IFRS 2 will not apply on that. Simple question from you. What are share options? What are share options? Okay, Hamza. Okay, Zayan. So shall I turn my webcam off if the voice is disturbing? Yes, good. Fair. Okay, let's explain. Share options are right to shares granted by company to employee or any investor. Normally this deal takes place between company and employee. Fair. Do we attach any conditions? So these are right to shares granted by a company to employee or any investor against some conditions. These are referred as vesting conditions. After satisfaction of which shares can be purchased at predetermined price, that is referred as exercise price or strike price. Easy. So if an employee or any employee fails to satisfy conditions, will not be getting the shares. Next question. What would be the fair value difference between value of share options and ordinary shares? Will there be any difference between the fair value of share options and ordinary shares? Good, Zayan. Sam, okay. Yes, always, Hamza. Why would there be a difference? There would always be difference between fair value of share options and ordinary shares due to number one, intrinsic value. Okay. What is intrinsic value? Intrinsic value is share price less exercise price. So, what if I asked you that would the fair value of share options be always equal to the intrinsic value? Hamza, well highlighted. Would the intrinsic value be greater or the fair value of options be greater? Zayan, what will be higher? Intrinsic value or the fair value of options? Wrong. Peter is right. Intrinsic value will always be higher than fair value of options. Why? Because intrinsic value is expected at future date. This is not immediately reliable. No, Amna. Fair value of options is different from the exercise price. Options means derivatives. Share options are derivatives. I'm not talking about the exercise price. Very nice, Krishan, I believe. So intrinsic value is gain that is expected at a future date. Why else is there difference between fair value of share options and intrinsic value? Anyone else? Why would there be difference between intrinsic value and fair value of share options? One is the difference between intrinsic value, and intrinsic value is expected to be received in future due to conditions attached with vesting of options. If someone believes that the actual share is worth $6 and an employee has an option to purchase the same for $4, right? Intrinsic value. If share price is worth $6 and employee can buy the same at $4, you would say that intrinsic value is $2. But there are doubts. Will any investor be getting these $2? Not necessarily. If an employee fails to satisfy the performance conditions, the vesting conditions, then these shares or the share options will not be exercisable, right? All right. We face market related performance conditions. What do you mean by market related performance conditions? Yes, anyone? Market related performance conditions. Sam, I'm telling that if the intrinsic value is $2, the fair value of share option, the fair value share of share option will not be 2 or more than 2. So see here, intrinsic value will always be greater than the fair value of option. So less than $2. The fair value of options will be less than $2 because there are conditions attached to it. Number one. Number two, these $2 are receivable at some future date, not today. So market related performance conditions are conditions related to share price of company or any stock market price index, right? What's your view? Do we take this into account? Do we take market related performance conditions in account? Very nice, Amna. Jane, please drop me a message on WhatsApp. I'm sending you my WhatsApp number. Good, Peter. Remember, I'm telling you, my answer is yes. We do take market related performance conditions as per IFRS 2, but when do we evaluate? In grant date fair value of share options. When we are determining the fair value of share options at grant date, we do take into account the market related performance condition, but are not remeasured at each reporting date and are not reflected in expected vesting percentage. Fine, easy with this, no confusions. If there are market conditions attached to an equity settled share based payment, we do take that into account when fair valuing the share options at grant date. And you do remember this well, that we do not remeasure fair value of share options at each reporting date, and we don't even remeasure the expected vesting rate considering those market conditions. We won't consider these market conditions. What are other are non-market related performance conditions. Yes, what are these? Simply not related to share price or market indexes. Hamza, you've got a question, a lengthy one. Yes, true. Hamza is asking that that in the book it is written that market-based performance conditions have already been factored into the fair value of equity instruments at the grant date, correct? And therefore, an expense is recognized irrespective of whether the market conditions are satisfied. True that, Hamza. I'm telling you that we will take into account market-related performance conditions only once, when only at the grant date. Subsequently, for equity settled share based payments, we never remeasure the fair value of share options, right? And we take into account the expected vesting rate, that how many number of employees do you think are expected to remain with you until vesting. Fair. So market related performance conditions will subsequently not be adjusted in expected vesting percentage. What can be non-market related performance conditions? Possibly, someone said sales target. Good. What else can it be? What possibly can non-market related performance conditions be? Sales target, and service condition. No, Ola, the price earning ratio would be market related. Length of service, yes, good. Zayan, what do you mean by IPO here? EPS, yes, okay. Okay, yes, okay. But that would be one-off event, right? All right. Do we consider this? Yes, both. At time of fair valuing share options at grant date and reflected annually at each year end in expected vesting rate. I'm not using handwritten notes. Yes, these one, the typed one. Yes, I'll be sharing these. I'll be sharing these, of course. Okay, easy with this. So one, there are equity settled share-based payments, and other are cash settled share-based payment. For equity settled, we debit asset if acquired or expense normally employee remuneration, and do we do credit what? Equity reserve, right? And how do we calculate equity reserve? As number of employees, expected number of shares. If you buy an asset, Akis, against equity settled share based payment, then you will be debiting asset. If you could recall, there are two methods of valuing. What does direct method mean? What does direct valuation mean? If value of goods or services can be measured reliably, then shares are valued using the value of goods or services as base. This is direct method. And what is indirect method? Opposite. If value of goods or services cannot be measured reliably, then expense or asset is measured with respect to fair value of equity instruments. Okay, so there is possibility that you might enjoy services against the equity settled share based payments most commonly, or you might buy an asset against the share based payment. And how do we use the indirect method? Number of employees multiplied by expected number of shares, fair value at grant date, right? Number of years past divided by total vesting period. Cash settled share-based payment. When company will settle any transaction at the fair value of its own equity instruments at future date. Paying in cash, right? So for equity settled share-based payment, we credit equity reserve. What's case with cash settled share-based payment? We credit liability. Perfect. So these are remeasured at each reporting date and are credited as liability. Commonly, what do we get in examples is SARs. What are SARs? Share appreciation rights. Good, Zayan. Share appreciation rights. In this case, of course, market-related performance condition cannot be ignored because you are directly, Ola, say, company's share is trading at $5 today. Company grants 3,000 share appreciation rights to each of its 5 directors who will receive cash equal to difference between share price after 3 years and current market value, provided they remain employed by that date. Expiry period is 2 years after vesting. So share appreciation rights. If my shares, the share price increases above $5, I'll be paying difference as a bonus to my directors. So here there are 5 directors multiplied by fair value at year end less $5 multiplied by 3,000 share appreciation rights multiplied by 1 divided by 3. What happens after vesting? A quick summary, then moving towards question. No, Ola, I don't pay each year the difference. I'll be crediting the difference to liability, but we'll pay right after 3 years. Amna, there are 2 different times. Number 1, 3 years is vesting period and 2 years is expiry period. Clear, Amna? 3 years are vesting period and 2 years are expiry period. Every option and right has an expiry period. See here, a short note. What happens after vesting? If the options if there are equity settled share based payments and these have vested, company does not remeasure after vesting till exercise. Yes, $5 is not an exercisable price, Noor. That is current fair value. So I'll only be giving my directors the difference between fair value at the date of exercise right? So $5 is what? Is my current share price. They are not supposed to pay me anything. For share appreciation rights, they are not supposed to pay me anything. If the equity settled share based payments have vested, the company will not remeasure its expense. Sam, we will not record any expense and liability. If the fair value of shares is less than even $5, we will not record any liability and expense. Yes, correct. And these are ultimately options, Zayan. Zayan is asking that if the employees are getting below fair value, that means intrinsic value is negative. And whenever the intrinsic value is negative, the holder never exercises the option. Nothing, Ola. You'll ignore it. Yes, Dayan. But higher than what? Intrinsic value is higher than what? Right? Note it. Remember, if exercisable value is greater than share value, intrinsic value is out the money. If you remember financial management, not feasible for option holder, and so the fair value of share options will be 0. Zayan, it is fair, it is lesser than fair value of what? Remember, we are talking about multiple things. Fair value of shares, fair value of share options, and intrinsic value. Intrinsic value is always greater than fair value of share options, right? So if the option goes out the money, the value falls below 0. That is technical area if you have covered in financial management, F9. So in case of cash settled share-based payments, company keeps on measuring its liability to fair value until SARs are exercised and any changes are charged to profit or loss. All right, so let's move to the question now. What's a year end? We are talking about the time to come practically, but in question, this is past. So point number 1, on 1st July 2020, how long before year end? On 1st July 2020, Lord Frey Limited offered 1,000 share options to each of its 500 employees. Yes, Jaya, question is attached in the handout section of this webinar as question number 3. The offer is conditional. Okay, let's highlight some important areas. We have got 1,000 share options. If these are share options, that means these are equity settled, right? To 500 employees. And offer is conditional upon completion of 5-year service. From the date the offer was given, the award of options would depend on attainment of the following additional conditions. So there are 3 conditions altogether. Condition number 1, employee must remain employed for 5 years. Number 2, average sales for the next 5 years are 300 million or more. This is condition number 2. What do you believe? Is this market condition or non-market related performance condition? Non-market. Good Hamza, good Ola, good Sam. And this should be considered when? Very nice. And this should be considered when? Both. Sam, both. Zayan, good, but both. Zayan says calculating grant date fair value, that is fine. Sam says at reporting date. Both are correct, but if joined together, we will have to consider this while determining the fair value at grant date and also at year end on expected vesting. Condition number 2. Yes, good Chesler, true that. We'll be considering both conditions at the time of fair valuing at grant date. Amna, you are right. At the end of 5th year, the share price of the company exceeds $200 per share. Which condition is this? Market condition. When do we consider this? Fine, Sam. When do we consider this? Do we even? No. Zayan, this is not cash settled. This is not cash settled. I am giving share options. Share options mean equity settled. I'll not be paying the cash, but shares will vest only if the share price reaches $200 or more. Oh yes, oh yes, yes. That's fine. True, Mojisala. This will be considered at exercise date, grant date, fair valuation. Good. And this will not be subsequently reflected while calculating the expected vesting percentage. So the market value of options, right? The market value of options at grant date were estimated as under. Each option is worth, Hamza, that is the vesting condition, but IFRS 2 ignores it. Right? It is the vesting condition, but IFRS 2 ignores it. Without taking any condition, the options will be valued at $50. Do you consider this relevant? Yes, Amna. IFRS 2 ignores market related performance conditions for the value for annual expenditure. Good, Zayan. Taking into account condition 1 only, it is 50, it's 44. Would this value be relevant? Amna, you are not right. Taking into account only condition 2 is 38, and taking into account both conditions is 36. Zayan, good. Hamza, wrong. Correct, Amna. Correct. So at grant date, we are supposed to take into account both conditions. Yes, fine. Yes, fine. So it's very easy to correct here by saying O, but correcting this in examination will take 3 months at least. Requirement A. Discuss with reference to IFRS 2 share-based payment impact of market-related and non-market related performance conditions on expense, and advise how should share options offered to employees by Frey Limited be accounted for in first year. Yes, inshallah, Hamza, you'll not be correcting it after 3 months. You'll go right in your very first attempt, inshallah. Okay. So the question asks us to discuss. We have already had enough, but let's start typing. When a company, or we can say that Frey Limited has granted share options to its employees based on certain performance conditions. This will be treated as equity settled share based payment as per principles of IFRS 2, where if the value of goods or services cannot be measured reliably, then indirect method of valuation applies. recording asset or expense at fair value of equity instruments granted, and if necessary charged over the vesting period, right? Share options must be measured at fair value at grant date and are not supposed to be remeasured at each reporting date. Market related performance conditions are only accounted for once initially while valuing share options at grant date and are not subsequently adjusted for changes through fair value or expected vesting, right? So you'll have to discuss and then start solving it. In case of pre-limited, share price or share option price of what value? $36 will be considered. That accounts for both conditions at grant date. Good. Sorry, I was just saying good. Was not supposed to write good. Therefore, yes, therefore, in first year, an expense should be charged to profit or loss and credited to equity reserve until exercise date. So how much would be charged for first year? Remuneration expense. How many number of employees? 500. How many options have been granted? 1,000 each. What's fair value? 36. How many years have passed? 1, right? Divided by 5. But we'll see if first condition is expected to be satisfied, right? I will have to multiply this with expected vesting rate. Getting my point? Here I am not applying any percentage of expected vesting. That expected vesting is dependent upon what? First condition. Let's see. Correct, Amna. Following information is available at year end. Sales for the year ended 30th June 21 were 210 million. How much was the target? Average annual sale of 300, and this is sale of first year. However, it is estimated that sales would increase by 20% each year. So let's perform calculations. Expected sales. How much was sale for the first year? Is 210. What do you think? And this will grow by? This is average, Amna, per year. 20%. Good. So see my formula. Multiplied by 210. Sorry, equal to 210 multiplied by 20% power 1. In fact, let's not put power. Let me know if you're not getting this. So total 5-year sale would be average annual sale is expected to be, okay, Ola, see here, your current year actual sale was 210, right? And we believe that our sales revenue will grow by 20% each year, right? So how much would be? Power could have worked. See here, it's 210. And if I'm using this 210 as a figure, then multiply by 1.2 and putting power of this. This can work. But because here I'm taking each previous year's figure, so power is not supposed to be applied. Sakib, it's shift 6. For the power. Cap. Ola, did you get this? So the sale of first year was actually 210. This would grow by 20%, further 20% compounding, then 20%, 20%, 20%. So our expected sales revenue for 5 years is expected to be 15 million, 1,563,000, 13 per year. So the target seems to be satisfied. Yes, Sam. But normally in examinations which are center based, you'll be getting those unbranded keyboard of Dell. So normally the buttons are common. Moving forward, the share price was 160. What do you think? This is not supposed to waste in that case. But of course, we will not consider the market related performance condition we have already discussed. It was estimated that 15% of employees would leave the company before completion of 5 years. So there we go. If you believe that 15% employees would leave your company, how much is the vesting percentage? How much is the vesting percentage? So that is 100 minus 15 percentage. So remuneration expense of 3,060,000 would be charged and credited to equity. We have already mentioned it, right? Okay, shall we move further? Zayan, could you see this 20% increase? Because if I have dragged the formula, that 20% is applying to the previous figure. Ola, to ensure whether the first condition is being satisfied, because first condition is non-market related performance condition, and that must be accounted for every year. If this would fail, you will not record the expense. Yes, Sam, debit to profit or loss? Yes, Zayan, because that is a market related performance condition. You can write it. Share price of $160 at year end seems to fail to meet the second condition, but this will be ignored as per IFRS 2. Yes, Ola. If the non-market related performance condition is not meeting, Demi, because you cannot control this, this would keep on fluctuating. At certain time, you will feel it is being satisfied, but by end of the year, you might fail. So because market related conditions are quite uncertain, and may create volatility. Yes, this is outside the control of the company and employee. Next part. In view of significant changes in technology, Ola, let me make you clear. There's always a confusion for students. You are saying that if market and non-market both conditions are applicable, and market condition is made, non-market condition will ignore it. Yes, true. Do remember, if you can clearly observe during vesting period that market conditions are not going to be satisfied and ultimately shares are not likely to, share options in fact, are not likely to meet, but you will have to continue recording expense and crediting equity, and in the end, if share options don't waste as expected, expense charged during vesting will not be reversed. Remember, you cannot reverse the expense. IFRS 2 is very rigid on this. Tries level best that an expense charged against IFRS 2 must not be reversed. Right? So we will continue to consider non-market related performance conditions only and ignore market related performance conditions throughout vesting period. Yes, Ola, you did consider market related performance conditions at the beginning of the year at the grant date, but by the end, I said during vesting, if you observe, not at grant date. Amna, that is normally treated as treasury shares. You do remember, what do we case in case of what do we do in case of modification? Anyone? What do we do in case of modification? I am spending a bit more time on IFRS 2. If you all are comfortable with this, then I should discuss it further. If you believe that this is not fruitful anymore, I must move to the other question. Sabina, should I move? Okay, Kausar. Fair. Mixed responses. Let me make it a bit quick. If modification increases the fair value of options, then additional expenses charged over remaining vesting, right? But if it reduces the fair value of options, then what? It is ignored. True. And what in case of cancellation? If we cancel, even if we cancel, this is treated as what? You do remember the terminology used by IFRS 2. This is treated as acceleration of vesting any expense that was supposed to be charged over remaining time must be charged immediately, right? So Amna, that is also the case with non-market related performance condition. Since we ignore what is in case of settlement, settlement is treated as buying back on shares as treasury shares up to fair value. Any excess payment is treated as an immediate expense. There is no point of gain. Yes, Ola. If we pay below the fair value, the gain will not be credited to profit or loss, but will remain within equity. Sabina, IFRS 2 does considers every minimum point to avoid reversal of expense. Company cannot reverse share-based expense. Remember, this is up to, Ola, I'm telling this is up to. So if company settles and pays up to the fair value, that is not treated as a gain. So you will simply debit equity reserve by the amount paid that is lower than fair value and credit cash or bank. Fair? No gain or loss. Yes, correct. Sam, these are your own shares. So you cannot record the gain. Remember, any expense recorded against share-based payments can never be reversed in future. No, it is not even gain within the equity, Ola. Like in case of revaluation surplus, any difference will remain within equity. As in case of revaluation surplus, it happens. Okay, now on the next area. IFRS 2 done for today. We will not be discussing IFRS 2 now. No, Moji, will not be reversed. Will not be reversed in any case. Our case. Only if your vesting rate changes, then fine. But if market related performance condition is not satisfied, you cannot reverse the expense even. What goes into equity remains in equity. In view of significant changes in technology, it has been decided to reduce the remaining useful life of plant by 5 years. What are we going to do? We are going to reduce the remaining life of plant by 5 years. No entry has been made for depreciation on plant and adjustments in relation to decommissioning costs for 2021. We have not recorded any adjustment for depreciation and decommissioning cost. On 1st July 2020, 1 year back, the plant had a carrying value of $150 million and remaining useful life was 11 years. Further, in respect of this plant, revaluation surplus of $24 million and provision for decommissioning cost of $40 million were also appearing in the books at that date. On 1st July 2020, we are talking about. There's no change in expected decommissioning cost except for the timing due to change in useful life. Earlier, you had how much time? 11 years. Now it is reduced by 5 years. Easy? I'm poor at this, I believe. I cannot copy it. Yes, that is the change in accounting estimate. Better try changing the screens. Like this, Zayan. Wrap the text. It's not showing here. Fair, leave it, leave it. Yes, this would be accounted for prospectively. Okay, Jaya. Final try. It's not working yet. For the same thing. No, leave it, leave it, leave it, leave it. Leave it. Taking time, uselessly. So, question number 3 and part B. Here? No, it's not doing either. Let's leave it. Question requirement. It says discuss and calculate the impact of change in accounting estimate for manufacturing plant on financial statements 30th June 2021. Okay, yeah. Fair, I'll try it later. I just worked for the numbers here, not on these texting on Excel. So, what's the case now? Company has revised its useful life of its what? Plant by 5 years. So reducing it from 11 years to 6 years. This change is a change in expected useful life of asset, and as per IAS 16 considered change in estimate and accounted for prospectively. Hamza, the life is 11 years. and on 1st July we have reduced it by 5 years. Yes, Zayan, there will be no carrying value. Yes, both. Amna, IS 16 says that this is a change in accounting estimate and should be accounted for prospectively under IAS 8. All right, so only depreciation charge for the year and years to follow will increase. This will not affect comparative statements, right? Depreciation charge for the year would be no. Why should this be accounted for as a change in account, a change in statement of SOCI, comprehensive income, profit or loss? Yes, Amna. Comparative statements are previous year statements, right? Okay, so this had a carrying value of 150 million, and the life has been revised to 6 years, right? So debit depreciation charge 25,000 and credit accumulated depreciation by same. Company has the revaluation. If the company makes an annual transfer from revaluation surplus to retained earnings in respect of excess depreciation, then an annual transfer would be calculated as follows. How do we calculate excess depreciation? Remember, if you are following the difference between previous depreciation and new depreciation, that is wrong approach. Please let me know immediately. How would I calculate excess depreciation? Hamza, that is perfect. That is a perfect way. Please respond immediately. How to calculate the excess depreciation? If you are going to calculate the existing depreciation and revised depreciation, this is not always going to work. Like the plant is having 150 million divided by 11 years, and now 150 million divided by 6 years. If you believe this is excess depreciation, this is wrong. Easy way is to simply divide revaluation surplus by revised useful life. How much revaluation surplus do we have? Revaluation surplus of 24 million. Okay, Hamza. 24 million divided by remaining life is 6 years. So this would be debited from revaluation surplus and credited to retained earnings. Hamza, this is not reported in OCI. No, this is not comprehensive income. This is a transfer that goes backdoor within a statement of changes in equity. Yes, this is not downward revaluation, Purist, correct. This is not downward revaluation. Purist, if you don't have the revaluation surplus, how come will you be having the excess depreciation? Ola, that is an option. That is an option. Ola is asking what are the circumstances when the company does not make an annual transfer. So making an annual transfer from surplus to retained earnings is an option. All right. Okay. Let's calculate decommissioning cost. What do we do with decommissioning cost? Any provision for dismantling, site restoration, or decommissioning is capitalized into cost of plant on initial measurement, right? That has been capitalized, Ola. Amna, since you have a revaluation surplus for this same asset, you must remember that as per IAS 16, normally companies make an annual transfer of excess depreciation from revaluation surplus to retained earnings. Since the plant has a revaluation surplus of 24 million, this must be or this should be transferred to retained earnings over the period of 6 years. Dep no. Revaluation is not calculated that way. Revaluation, sorry, depreciation. Depreciation is simply calculated at. Okay, so this has already been capitalized. What are we supposed to do with decommissioning? But any remeasurements due to cost estimates, rate estimates, or time estimates are not adjusted into cost of asset but reflected into profit or loss. Demi, if you didn't have any revaluation surplus, then you were not supposed to talk about the excess transfer. Sorry, but I need to open webcam for some immediate purposes. This is very important. Mango shake. I I can close it later. Purpose is served. Closing it. Takib, what we say in our language, Allah dega. Okay. So any provision for dismantling is capitalized into the cost of asset. Okay. So any revision in estimates are reflected to profit or loss. Now let's calculate the expected cost of dismantling. How is Oh, Akash, yes. So I saved some because exporting to Dubai, I saved some mangoes here. How much is your provision? Discounted present value. How much provision are you showing already on 1st July 2020? 40, good. And Hamza, this is already discounted present value, right? Okay. So we'll take it to future value first. Question says everything is same. Everything is same. Only the timing has changed. Yes, Hamza, this was discounted at present value on initial recognition and had must have been compounded so far. So we have got provision of 40 million multiplied by 11% and power 11 years. See the formula. Let me know if there is any confusion with this. I'm calculating the future value. Please see it. 40 million. Yes, Hamza, this is simple compounding. So this is estimated cost of dismantling, future value, which was earlier discounted for 11 years and shown at 40 million. But since cost is expected to be same, present value would be okay. Your discount rate is 11%. And what power should I apply now? What power should I apply now? 6 years, Sam. Good. Very nice, Cat. Fair. So change in estimate. Has my provision increased or decreased? Increased by 27 million. What should I do? Debit profit or loss immediately by this amount and credit provision for decommissioning by the same amount. This is supposed to be done at 1st July 2020. Zayan, it is. Excess depreciation is charged to profit or loss. You can see for the year how much depreciation have we charged. It's 25,000, which is already increased. Getting Zayan? Yes, okay. Future value. Ola, see this. Were you easy with this? I had present value of provision of 40 million that was discounted using 11% for 11 years. When I compounded it back, I learned that it is 126 million and 70. Fine. Discounted over 11 years, this was being reported at 40,000. I took the same future value and converted into present value, but using the life of 6 years now. So my provision immediately increased from 40,000 to 67 million. This is immediately charged to profit loss. Now, whenever there is a provision, there is always unwinding of discount, compounding. A finance cost must be charged every year to compound the present value of provision to its estimated future value, reflecting time value of money, right? So let's debit finance cost for the year and credit provision for dismantling. By what amount would you be debiting the finance cost? Ola, is this typo? Like, or have you applied this finance cost as 27,000? Let me check. Possible mistake. No. Yes, good, good, Sam. 67 million, 11%. Good. Ola, how did you get this? We are not supposed to apply this on 27 million only. That is to be applied on 67 million. The value of your provision at 1st July. Ola, got it? And why are you applying 6%? Rate is 11%. Carol, it was already present value. The present value that was dependent on 11 years. Since there are no further 11 years left, we have revised the life to 6 years now. So first we calculated the future value. This was originally estimated. Earlier we were discounting it over 11 years using this exactly same thing. Like you can see this. We had future value of this divided by 11% and power 11 years. It was for, and now I have to discount it over 6 years. This is supposed to be charged to profit or loss. Carol, let me know if the confusion is there. Okay, so decommissioning, unwinding of discount. No confusion with this figure. Fair. So applicable discount rate is 11%. It is policy of Frey Limited to transfer revaluation surplus to returnees upon disposal only. So we were not supposed to make the annual transfer. I am cancelling this part. Right? We were not supposed to make the annual transfer because in the last part of the question, it is mentioned that the company does not make annual transfer of excess depreciation, right? So we are not going to revise our solution now. Exhibit 3. Read it carefully. Yes, Dayan. It says the transfer is only made at the time of disposal. Let's see its further requirement. Explain criteria for classifying a financial asset at FPT OCI as per IFRS 9 and show carrying amount of 12% debentures as of 30th June 2021. We have got two requirements. Criteria for classifying asset at FET-OCI. What are criteria? And carrying value of specified in the question 12% debentures. Sure, Amna, anytime, anytime. You can ask me again if you can't understand it. Good. Carry on, Hamza, good. Not for purpose of trading, Ola, carry on, carry on. Zayan, good. What are criteria for classifying any asset at FET-OCI? Debt instruments acquired by an entity can be classified as FET-OCI if good, Zayan. Good, Mojisula. You seem comfortable on this, so I'm not typing lengthy answer. Number one, not held for trading. Number two, meets cash flow characteristics test. Number three, business objective is achieved by holding some assets till maturity and selling some assets to realize market value changes. Fine, Amna, true. Do remember, this business objective is always a general model. This is a general test. Whereas the cash flow characteristics is asset specific. Right? Comfortable with these terms? What does asset specific and general test mean? You know well? Okay, Ola doesn't know. Anyone else? Okay, Moji. And Amna, Purist doesn't know. Sabina doesn't know. Zayan, it is different. But what does general and specific mean? We know that cash flow is made only if the payments are contractual cash flows are interest and principal. That is fine. I'm not typing that. You all are good at it. Good at that. What is difference between asset specific and general test? Okay. See, this question, this test is asked for asset to asset. Like if you have got investment in three different bonds or three different financial assets, three different debt instruments, you will have to pass this test for all three assets separately. So asset 1 may meet it, asset 2 may meet it, and asset 3 may fail it. Got it? When confirming about cash flow characteristics, IFRS 9 will ask this question specifically. If you have got three financial assets, debt instruments, you will be asked about asset number one, let's say 8% bonds. Will these bonds be paying interest and principal only? You said yes. Test passed. You have got, let's say, 11% redeemable preference shares. I'll ask the question again. Will these preference shares be paying interest and principal only? You said yes. Pass. Got 9% debenture. And I asked, will these be paying interest and principal only? You said no, these are convertible into shares. Fail. Right? So cash flow characteristics test model will be asked over one asset to another. If you have got three financial assets, I'll ask question three times. But business objective, yeah, business test model is general test. I will not point out any specific financial asset. Yes, Amna, convertible debentures at FVTPL, they will fail the cash flow characteristics test model. I'll be asking generally, I'll not be pointing over those 9% bonds, 11% preference shares, or 7% debentures. I'll not be pointing out. I'll be asking generally, how is your business model achieved? And you have to give me one answer. Generally, that we always hold our instruments till maturity, or we at times hold till maturity and we at times sell before maturity. But I'll not be pointing out at three different financial assets. That is an overall business intention. Good. So well summarized, Amna. Moving forward. No. If Mojisola, you're saying if business model is passed, but cash flow is failed, will it be measured at FETOCI? No, not at all. This is sequence. You must follow the sequence. First, it should not be held for trading. If held for trading, this will go to FETOCI. I'll not be bothering to ask another question, because if it is held for trading, I'll not be moving towards second question. Similarly, I'll ask second question about cash flow test. If it passed, I'll be moving towards question number 3. If this failed, I'll immediately take it to FETPL. I'll not bother asking third question. Right? And finally, if company does not exercise the fair value option to eliminate or minimize accounting mismatch. So these are the conditions. While equity instruments are always carried at fair value, if not held for trading, company can choose OCI option to reflect changes in fair value directly into OCI to avoid its performance from main activities to be volatile. Good. Okay, so let's move towards calculations now. On 1st July 2020, Zayan, compound instruments, in case you are issuer, if you are investor, you have got no headache of splitting it into debt and equity. Amna, see the requirement here. Explain criteria for classifying a financial asset. Right? If it was written, explain criteria for classifying a debt instrument financial asset. Fair. Zayan, yes, if you are issuer, then compound instrument is split both into debt and equity, right? Hybrid instruments. Embedded derivative, yes, correct. And liability component is measured at amortized cost. Yes, good. Okay. There we go. Frey Limited purchased 2.5 million debentures having face value of $100 each, issued by Peso Limited. Debentures were purchased at $103 each. Zayan, if you're an investor and you have acquired convertibles that will fail cash flow characteristics test, and any instrument that fails cash flow characteristics test, that is measured at FVTPL. So convertible bonds as a financial asset are always measured at FVTPL. Issued by Peso Limited, debentures were purchased for 103. However, the fair value of each debenture on the date of purchase was 105 in the quoted market. Transaction cost of $1.5 million was also incurred on purchase of debentures. Okay, first question. At what value should I record the debentures initially? 100, 103, or 105? At what value should I record these debentures at? I've got three answers first. Three are wrong. Zayan, Moji, you are correct. Sakib, you are wrong. Sam, you are right. Amna, you are perfectly right. Chesler, you are right. Jaya, you are right. Okay. So, as per IFRS 9, financial instruments must initially be recorded at what? Good, Ola. Fair value. You are telling me fair value and you asked me to record at par value. Why are you doing so? Okay. So as per IFRS 9, financial instruments must be initially recorded at fair value at or less in case of financial assets and financial liabilities unless measured at, you can correct the mistake here, Ola, immediately, but don't make such mistake in paper. You know the punishment. And financial liability unless measured at FVTPL transaction cost. So we add the transaction cost in case of financial asset, and we deduct transaction cost in case of liabilities. Sam, subsequent measurement will be decided later. Subsequently, we have got three options: FVTPL, FVTOCI, and amortized cost. Fair. Let's read further. Coupon rate of debentures is 12%, which is payable annually on 30th June. Frey Limited has classified the investment in debentures at FVTOCI. So initially this would be recorded at, since these debentures are subsequently measured at FVTOCI, these must be recorded at fair value initially plus transaction cost. Any gain or loss on initial recognition is taken to profit or loss. Mojisola, IAS 32 deals with certain parts only. IAS 32 deals with classification of debt and equity, only deals with classification of debt and equity as an issuer. It deals with acquisition of treasury shares. It deals with principles of netting off and putable instruments. Right, Moji? So IAS 32 has limited scope. IFRS 9 deals with rest. No, Amna. The gain or loss on initial recognition is taken to profit or loss. Sam, then leave it. Then leave it. If you are hearing putable instrument for first time, that is not very important. You can either Google it or search it in your book. That's not very difficult. But we cannot spend time here on that now, right? Okay. So debit, financial asset. How much is fair value? Sorry, there we go. We bought it for 103. Doesn't matter. How much is fair value? 105. And how many debentures have you purchased? 2.5 million. So 2.5 million at 105 plus transaction cost is 1.5 million. Let me know if you couldn't get me. Clear? Good. Credit with, we have recorded it at 105. So 2,500 debentures, 105 is fair value plus 1,500 transaction cost. We are initially recording it at fair value plus transaction cost. Okay, Ved? Clear? Credit cash or bank. How much have we paid? 2,500 bonds, right? Multiplied by, you bought it for 103 plus you also have paid the transaction cost. Difference, credit, profit or loss. That is gain on initial recognition. Yes, Amna. On initial recognition, entire gains or losses go to profit or loss. FVTOCI will apply subsequently, not initially. Fair. Subsequently, the investment is classified as FVTOCI. So an effective interest must be recorded as an income, and any difference between amortized carrying value and fair value is taken to other comprehensive income. Fair. So for the first year, brought down finance cost, coupon, CD, fair value, other comprehensive income. Sam, initial recognition. Yes. Okay, you made it clear. You made it clear. Is my voice still disturbing? Yes, Amna, that is not a big deal. You can use shortcuts. I've put off my hands-free on the table now because I'm not able to hear you, of course. Okay, brought down balance at 264, right? How much is effective interest? It says it's 12%, 12%, yes. The coupon and effective is same, I believe. At initial recognition, Frey Limited determined that debentures were not credit impaired. Sorry, Jaya, why you mentioned about what? Effective interest rate. Yes, don't forget. I need to turn my webcam on. Not for Mango Shake this time, but to show my expressions on this. Remember one thing. Even if you are carrying your instrument at FVTOCI, you will continue amortizing it. Date instrument financial assets are continue to be amortized in normal way, with only the difference between carried down as per amortized cost and fair value is taken to other comprehensive income. You cannot skip charging the effective interest rate. Thank you, Akis. Right, Jaya? Clear on this? We will not stop charging effective interest rate under date instruments FVTOCI. Ola, I was saying that you are not merely supposed to compare the fair value at the start of the year with the fair value at the end of the year for FVTOCI instruments. If you believe that the fair value at the start of the year and the fair value at the end of the year, the difference between these two is taken to other comprehensive income, you are wrong. Date instruments will continue to be amortized. Zayan, no, no. Even if the purchase price is same, even if the purchase price is same as fair value, FVTOCI instrument must be amortized and then revalued every year. Every year. Oh yes, initially. Fine. Hamza, since we cannot see if there is any effective interest provided, is there any effective interest provided? I can't see any. Yes, sure. Paula, we are coming over this now. So, Hamza, we are taking 12% as effective interest, right? But effective interest applies on what? Brought down balance. So, Ola, you can see this. Although we have got debentures at FVTOCI, I am applying effective interest on opening balance. At what value is coupon always applied? Par, very nice. And how much is par value? It was 100. I'm not supposed to change the screen now. So 2.5 million bonds, 100 each, right? At 12%. Fair. So how much would my CD balance be? How should this finance cost be recorded? Yeah. Have I missed something? Okay. So let's pass the double entry for this. Debit cash. How much interest are we supposed to receive? Sam, nothing to do with NCR so far. Coming over that, Ola, I told you that under FVTOCI, the difference between amortized cost and fair value is taken to other comprehensive income, right? I am initially determining the amortized cost. Let's complete that section first. Fair. Hamza, you will not debit finance income. This is your income. This is not your expense. You are an investor. You're not an investee, right? Good. So debit cash, credit finance income, and debiting financial asset by the difference. Sam, we are not supposed to pay the interest. We are receiving the interest. Sam, clear? We are investors, right? Okay. Next. Now let's see. No, Sakib. This goes to profit or loss. This part goes to profit or loss. Only fair value changes are taken to other comprehensive income. Next. How much is fair value at the end of the year? Okay, of course. My mistake. My mistake. I wrote finance cost here. Correct. Next. It says that on 30th June 2020, the debentures were quoted on the stock exchange as 109. Hamza. 105 was at the date of acquisition. Fair? So investment has gained value. Let's calculate now. At what value will you record this? How many bonds do you have? 2,500. Good. Multiplied by 109. How much is difference? Yes, Jaya. This is interest income. You can say interest income rather than finance income. You can, of course, of course. Easy. Hamza, how come is this loss? I can see it's profit. The value of your asset has increased. Fair. How would you deal this? Debit. Financial asset. And credit. Other comprehensive income. But same. Okay. Just give me 2 minutes. Just give me 2 minutes. I'm coming back. I'm pausing my screen. I'll be getting back. Don't go anywhere. This is not break. All right, back. I'm back. Okay. Yes, Jaya, you was telling me something. Oh, yes. Jaya, you're right. We can see the fair value is 272 and continue capitalizing the transaction cost. Fair, we will continue capitalizing the transaction cost. So the other comprehensive income would be 8.3 million. Okay, Kausar, is it better now or has get great difference? The difference between video and voice. Not yet. Like, is this difference between my webcam? Moji, you cannot get that option. Fair. If the webcam is disturbing, then I can close it because we have to focus on this Excel. Okay. So easy with this. Brought down balance, finance income, coupon. Then there is the carry down balance, fair value. Fair value must include the transaction cost as well. So this would be FET OCI. Sorry, OCI. Finally, okay, it says that Frey Limited estimated that 12 months expected credit losses in respect of investment in debentures at 1st July and 30th June. Fair. So possibly there is a connection problem. Let me switch to backup. Are you getting my voice now? It's back. Amna, okay, it's back. Is it back? Fair, 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 fair. Let's continue. So we said if the investment is not credit impaired, we should record 12-month expected credit losses. How are we supposed to deal with the credit losses? At 1st July 2020, expect credit loss 8 million. Good. So we'll debit what? Profit or loss by 8 million and credit what? Loss allowance. Good. Uh, is there any? Let's see. 1st July, the loss was estimated to be 8 million and it is 6 million later. It has reduced. There is a possibility of reduction in allowance for doubtful dates. Amna, okay? At 30th, yes. So we are supposed to record the credit impairment loss on 1st July at initial recognition. And this is also 1st July 2020. Yes, Amna. Credit impairment is always recorded at initial recognition. Subsequently, if the credit risk deteriorates, then the company must switch from 12-month expected credit losses, lifetime expected credit losses. Am I audible now? Okay, okay. So back. Your question, Zayan, is cash flow characteristics general. Have you? No, this is the previous question. Okay, 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 okay. Fair. Shall we move? Amna, remember, when we used to record trade receivables, and we also used to record allowances for doubtful dates. We used to show two different accounts. Receivable were used to were shown separately, and allowances for doubtful dates were shown separately. But we cannot say that allowances for doubtful dates are liability. Sam, it is not like we are not expecting any interest payments from the issuer. It's not like that. But we always have to be prudent. When we used to follow IAS 39, there were incurred loss approach. We only used to record loss when the bad debt had already incurred. Right? So we are just being prudent. We are not expecting that the creditor or the issuer will not pay us. Sorry, the issuer will not pay us. But IFRS 9 requires that you must record an allowance. So if you have even 0.5% doubt that the contractual cash flows will not be as contracted, you should record that 0.5% as allowance for doubtful date. Amna, using the term provision for doubtful dates is wrong. Please, we must correct our language. Provision refers to a liability. Allowances are not liability. Allowances are just contra to assets. Yes. Okay. Let's revise the provision now. By end of the year, Sam, how can companies abuse the prudent concept? Because we are recording the losses right before they incur. How can company benefit by recording a loss? If you may mean that this will be mistreated like provisions used to be, then IFRS 9 is bit strict. Where so, Amna, there has been restored now. Okay, so by the end of the year, the company believes the allowances of 6 million. Amna, I was asking that the treatment of bad dates is different from, right? Treatment of bad dates is different from treatment of allowances for doubtful dates. Allowances for doubtful dates are shown as a contra to receivables, whereas bad debts are removed from the receivables account. Same goes with 12-month expected credit loss, with lifetime expected credit loss, and credit impairment. Whenever there is credit impairment, we will write off the financial asset. We'll write off the financial asset. Whereas in case of expected credit losses, wait a minute. No. Hello. अच्छा, कैमरा शॉट मैं ऑफ कर देता हूँ, एक सेकंड, मुझे यहाँ कैमरा का ऑप्शन नहीं मिल रहा. ओके ओके, मैंने ऑफ कर दिया. ओके ओके, sorry, I'm back. I've just turned my webcam off. Hi Hamza. Okay, so now we can see the loss allowance has reversed to 6 million. So we'll be debiting the loss allowance now because it is reduced, and crediting what? Profit or loss. Clear on this? That is the difference between, oh, my mistake. Yes, sorry, my mistake. So it's 2 million, right? It says upon purchase, transaction price was recorded as financial asset, whereas the transaction cost was charged to profit or loss, right? Upon purchase cost, the transaction price was recorded as financial asset, whereas the transaction cost was charged to profit or loss. Interest has been received and taken to profit or loss. No further entries have been made. Let's observe the first confusion. At what value has the financial asset been recorded? At what value has the financial asset been recorded? Purchase price 103. Good. No, Sam, the fair should have been recorded. Sam, you're telling me with at the value that should have been recorded, but at what value it had been recorded? It says the transaction price was recorded. So we have recorded the financial asset at cost. Let's pass the journal entry for correcting it. So debiting financial asset, only accounting for date of acquisition adjustment. First, Jay, I'm coming line by line. At what value have you purchased it? That was 259. Right? So let's observe the difference. We acquired how many bonds? 2,500. At what value should be recorded? 105. At what value has it been recorded? 103. I'll pass the journal entry for transaction cost separately and credit what? Profit or loss on initial recognition. Fair? So financial asset must be recorded at fair value, not at cost. Therefore, gain of 5 million is recorded in profit or loss. Next, what has the treatment of transaction cost been? The transaction cost was charged to profit or loss. Whereas by us, Hamza, by us was added to fair value. Transaction cost for financial assets except FETPL must be capitalized into fair value at initial recognition. So debit financial asset by how much was transaction cost? 1.5, and credit profit or loss. Remember, we are reversing it. Next, interest must be calculated on effective basis on initially recognized value without deducting loss allowance, as interest shall be charged on gross amount. Okay, so how much was our finance cost? Sorry, not finance cost. How much was our interest income? Amortizing interest income for the year was 31680, out of which 30,000 has been debited as cash and credited as interest income. We are just supposed to deal with the difference. All right, we are just supposed to deal with the difference. So we should credit the interest income by 1680, the difference, and debit financial asset by the same amount. Let me know if there is any confusion. D. Explain. Yes, Amna. Do you mean this, Ola? Amna, want to say something? One 1680. Okay. 1680 is the difference between effective and coupon. Yes, true. Ola, okay with this? Amna, you're saying making these two journal entries, we are supposed to increase the asset by 5,000 and 1,500. Yes, correct. So your asset has already been recorded at what? Asset has been recorded at cost. That is 2,500 multiplied by 130, right? 103, my mistake. 103. So first you are debiting it to reflect fair value by 5,000. Later you are adjusting it for effective interest. Effective interest is 1,500. We have not reverse finance income, I believe. We have reversed the transaction cost. Purus. We have simply reversed the transaction cost because they have charged transaction cost to profit or loss. So amortized cost of the asset would be then we'll add fair value gain. Fair value gain is of 8320 less loss allowance. Loss allowance at year end is 6,000. So carrying value of asset would be Zayan, because the company has recorded it at cost. This was at initial recognition. Because you should have recorded the asset at fair value, but the company has recorded it at cost. Purus. We have credited the interest income. So we are recording an extra income. What have they actually done? See, management has recorded only coupon interest has been credited to profit or loss, while company must record interest income at effective rate. Yes, because Hamza, you can see here the question specified that the transaction cost has been charged to profit or loss, but this shouldn't be. Amna, let's see. The carrying value of asset would be should be equal to the fair value. Carrying value of debentures. The debentures must be measured at fair value at year end. How much is fair value at year end plus transaction cost? You can see the amortized cost. It is 274, right? Less loss allowance, allowances for doubtful date. How much allowance have you set for it? 6,000. Yes, like 80,000. Correct. Sorry, I missed the transaction cost. Sorry, I missed the transaction cost. Here, we'll have to capitalize the transaction cost as well. Have I recorded? Wait a minute. Cost plus fair value plus effective interest. 264. Then there was a fair value gain. I believe transaction cost would be difference. Let's see. It's 268. What have I missed? And 266,000. 1680. What was amount of 1680? Okay. Effective interest. cost. Wait, my bad. This was transaction cost. Then let's add effective interest. How much effective interest have we debited into asset? 1680. Yes, Akib? There we go. Yes, yes. Again, don't say that, Amna. Is my screen stuck again? No, it's fine. Thank God. Amna, got this? So I just missed recording that effective interest part. You can see our figures are balanced. So at year end, the debenture should be reported at 268 million, 268 million. All right, so we are short of time now. Let's immediately see a cash flow question. I've tried to copy a question from past papers. Do we have a Wobert in any kit? BPP Kaplan anywhere? Do we have question Wobert? See here on my screen. Hola, do we have in which kit? Because I recently gone through the new SBR kits, I couldn't find this question. Okay, Sam. Anyone who have witnessed this question? No? Okay, so we'll obviously not be able to solve this question today, but I've tried to construct it. Zayan, explanatory notes actually doesn't have any format. Let me show you clearly this PDF. There is no such format. Sorry, I cannot show you mocks. I'm pausing my screen so that there are mocks available here. For just for a second, deliberately, I'm pausing my screen, freezing my screen. Don't assume the connection lost. Zayan is asking me to show how to go through the explanatory notes. So I'm showing there are no such formats for explanatory notes. We can open any past paper. Fair. We can see this. Is my screen visible? Okay. Zayan, that was a good question. That how would we format the explanatory notes? See, what is the requirement of the question here? Draft an explanatory note to the directors of sugar company. Let's see its answer. It says the question is started immediately from solving the question. There is no such format. Easy. You can check other times as well. This question requires draft and explanatory note. And here are the answers. There is no format for the explanatory notes. Yes, Zayan, simply type at the top of the Excel that this is appendix 1. Okay, so we are done with it. I have drafted a question for cash flows as well, Amna. So I personally believe we cannot get enough time to solve it today. I can go through some technical areas of the question and will be sharing the question with you on WhatsApp to try to solve it. We are not getting disconnected, right? Amna, to be very honest, I'm personally enjoying, though it was disappointing for day 2 or day 3 after seeing the WhatsApp group for some time, but I'm glad. I'm happy now, and I personally wish that I could have more sessions. That makes sense, Akis. Do one thing, simply go through some past papers and answers. If the examiner has mentioned, I do remember that for 1 or 2 attempts, I could see that explanatory notes to the directors was mentioned at the top of the page, and then the answer was started. Mojisola immediately, because daily I was getting some students who were requesting me to join the group, so I was waiting for them to join. As you know that WhatsApp cannot continue recording it. When some new participant joins it, he or she cannot access the previous documents. But as we are already full, so I can share the documents immediately. Your feedback will definitely be encouraging for me, but should be neutral. I don't want you to be biased or in buttering mode. Let's see, I could open my webcam. I enjoy seeing myself. Okay, Zayan. So if you see, because I have been observing that at few times the examiner has mentioned some format of explanatory notes, and at sometimes past papers, that is not a big deal. Then people can see me, but I cannot see people, and I cannot see myself even. Okay, uh, you can see my screen. I have provided you with. Thank you so much, Ada. But by heart, yes, of course. You keep attached. Like we should be connected on WhatsApp, not just for this SBR, but when I'll be visiting your countries, I'll touch you even, or whenever you people are here in Sindh or Pakistan. System doesn't want you to see me. Am I audible now? Jaya, I have been to Malaysia. You're from Malaysia, I believe. So I have been to Malaysia. Like I was in Malaysia right before this lockdown on March 2020. But thank God I came back right on the right time. Yes, in KL and Langkawi. I've been there. Norway. Norway, okay. Seems Norway. Okay. Shakib, anytime you can tell me your address because I live at a place where the Bombay bakery is very accessible, and I have had enough cakes of Bombay bakery here. You can tell me your address. I can deliver. Oh, Shakib, you are in Dubai. Oh yes, I forgot. You were longing for the mangoes as well. Akash, you are in London. And which city? London. Shakib, if anyone is flying from here to Dubai, I can send you. I can, of course. But let me know if someone is coming there. Okay, I have plans to visit London because my friend is inviting me repeatedly, and I've never been there. No, no, I've never visited Romania. I've been to Russia, yes, and I've been to Dubai multiple times, Thailand, Bangkok multiple times, Malaysia, Singapore multiple times, India, yes. Sakib, connect me. You can WhatsApp me if someone is coming. I can send you. Uh, Everness, I'm sending you at WhatsApp. Are you there? Are you present there on WhatsApp? I don't remember to see your name. Everness. Sure, Florence. I'll be sharing handouts right now. And the question on the on my screen, I'll also be sharing this. Uh, I've You can see I've crossed AFS. AFS was a former name for FETOCI. Yes, Ved, you can attempt the mocks or questions. You can send me your answers, and because I am having plenty of time right now due to lockdown, then I can get enough time to check it. Sure, Sakib, anytime, anytime. Akis, connect me on WhatsApp if you are there. But I'm planning to visit London, of course. Moji, I have the mock questions, but I told you these are confidential. But I can see if I could access the education hub, I'll send you if I'm allowed to. Sure, Amna, you can send your answers. Attempt the mock, you can send your answers. Sam, I do. But whenever I'm busy, I sleep very less. But I get fresh. Like at this hour out of time, you can see I'm fresh. But when I get enough time, I sleep well. Thank you so much, Florence. It was nice being with you, and I would appreciate your feedback because feedback should be for improvements, not for buttering, please. So I'm not kind of person who is always happy to hear admiration. But if you are there to criticize, if you can highlight me the areas or the points where I can improve, and there is always room of improvement. Thank you, Avanish. I'll be sending this question as well, and hopefully we'll be solving this on WhatsApp. Those who are very scared of cash flows and have sawn in their dream that cash flow is definitely coming this session. So if they are worried about the winter and the winter is coming, we'll get ready for it. I'll be sending this question to you on WhatsApp, and we can try it there. I can even connect you on Zoom if you wish. As I told, money is not important. So not through this webinar platform, but we can stay connected. If you want to connect me on Zoom, and I can deliver an online lecture for you. If you have troubles in any particular topic, I'll be glad to guide. I'll be very glad to guide. Amna, let's talk on WhatsApp then about the thing you're talking here. Right? So everyone, a big thank you, and do remember to share your feedback with me. If ACCA has allowed an option to share feedback regarding the presenter, be neutral, please. Be neutral, please. And I personally enjoyed being with you, and I wish to be connected, to stay connected with you on WhatsApp. And very good luck and best wishes for the SBR attempt. May this be your first and last, and a marking and a scoring paper. Best of luck. Thank you so much. Thank you so much, Hamza. You're an exceptional student. I could see you were helping many students on WhatsApp throughout. Anything you want to say? We will stay connected. This should be the last day of webinar, not a connection, right? Goodbye, goodbye. Thank you, Perez. Enjoyed being with you. Thanks a lot, Mojisola. I would remember your name. Inshallah, Hamza. Inshallah. Adarsh, you've been very silent, but thank you so much for your feedback. Thanks a lot. To you too, Chesler. To you too. God bless you. Thank you, Tawfiq. Thank you so much, Tawfiq. So nice of you. Thank you so much. Let me try reading your name. Sorry for my pronunciation. Krishnanthan, right? Krishnanthan. So if this is wrong, please correct me on WhatsApp audio message, as we'll be staying connected. Best of luck. May God bless you. And any trouble, don't feel free to feel free to contact. Don't hesitate. No, don't ever hesitate. Thanks a lot, Everness. I've just received your message and I'm adding you to the group as well. We'll stay in touch. This nickname is still difficult. Krushant. Krushant. Krushant, where are you from? Sri Lanka. Okay, I've never been there, but I will definitely visit it because we often get connected flights to Sri Lanka from Sri Lanka. But I will definitely be there. Hopefully someday. Kiru, even better, even better. That's better. I can call you Kiru. All right, take very good care of yourself, guys and girls. And as I said, we'll remain in touch. Goodbye. Hamza, because I was trying to click a screenshot for your messages. Very lovely messages. Yes, always welcomes me. Thanks a lot, Kiru. So, ending it now. Good night. Goodbye. Thank you.